Good day, everyone, and welcome to another Africa iShare platform discussion. Today, we will take a different kind of structure. So we will be looking at a practical example of some of the discussions we normally have. And today, we'll be looking at how Africa loses on taxing rights. So this is a small example that we have created. So on the diagram, you see that there's a private equity fund, and we have the example that it's in Europe. And then the private equity fund wants to invest in Africa. And in this case, it wants to invest in a company in Kenya. So what the private equity fund does is that instead of coming directly and injecting capital in the Kenyan company, what it does is that it sets up another company in a tax haven. So you can think of any tax haven or any jurisdiction with very low tax. So what the private equity fund does is that it sets up a company which is going to be like a go-between in a low tax jurisdiction. And then the company in the low tax jurisdiction is the one that injects capital into Kenya. So now this is how the money will flow. The money will come from the private equity fund in Europe, and then some of the money will go to the company in the tax haven, and then from the tax haven, the money will be injected into the Kenyan company. Of course, this is a very simple illustration. Sometimes the structure is very, very comprehensive. You might find that the private equity fund has several companies in different tax havens, depending on what sector they're investing in. So consider, for instance, if the company in Kenya has a lot of intangibles, you could choose to have the capital coming in from a tax haven and have another company in a place with very favorable taxation of intangibles. Intangibles here, we are speaking about like intellectual property. So maybe the Kenyan company has valuable trademarks at the very small example, or a patent. So what you do is that you set up in a company that in a country that is favorable in that regard. So what happens is that when the Kenyan company is paying like for the okay, let's take a step back. Once you set up in the jurisdiction that has a favorable intellectual property regime, what you do is that if the Kenyan company had that patent, you transfer that patent to the other jurisdiction which is favorable. Then now Kenya will lease the use of that intangible, so that now Kenya will have to be paying the company in the jurisdiction with a favorable intellectual property or intangibles regime. And that way, what happens is that you will get a lot more of money out of Kenya without taxing it. Or even if it's taxed in Kenya, when it goes to like the tax haven or to the favorable jurisdiction, there's no tax there. But let's take it a step at a time. Let's go back to the diagram. So here, as we are looking at this situation where the private equity fund is just injecting capital, which will be in the form of shares, and also let's mix it up with some debt. So you give capital in the form of shares and debt in the form of a loan. So the private equity fund pushes the money to the company in the tax haven, and then when it's hitting Kenya, it hits Kenya as both as a loan and as shares. Okay, so I hope we are clear to this point. So now Kenya has two obligations. On the shares, it will need to pay dividends because a return of investment in shares, you pay dividends. And then for the amount of the loan, Kenya will have to pay interest on the loan. So the interest on the loan, how it works is that in Kenya, the interest is an expense. So it will reduce the taxable amount in Kenya. So let's say the money that the Kenyan company makes is $1 million US. Then it has interest of like $500,000 US. The taxable profit that remains in Kenya will be 500,000 US dollars. So you see the interest, but for the interest, the Kenyan company would have been taxed on the entire 1 million US dollars. So you use the debt and the return on the debt, the interest, to be able to reduce the taxable amount in Kenya. Of course, there are many rules that Kenya has in place to make sure that there's no abuse of there's no abuse by taking advantage of the interest expense by allowing too much of it. They're called thin capitalization rules. But in this example, let's imagine they're complying with the thin capitalization rules and interest is given as an expense. So one, the Kenyan base is eroded by how much interest is being paid out. If it's well structured, that interest will get out of Kenya with just withholding tax getting out of Kenya, and then you also at the same time reduce the amount of tax that's being paid in Kenya by XX Kenya Limited. But then even more on how Kenya can lose on this deal is that, private equity funds do not invest forever. So after a period of time, 5-10 years, they have realized the profit, the return that they needed, they will have to cash out. The strategic thing is that the private equity fund in Europe will sell the shares of XX Company Limited in Europe. So now what happens is that the transaction will never even ever hit the Kenyan books. The Kenya authorities may never even realize that this transaction took place, because now what happens is that in Europe, the private equity fund finds someone it wants to sell the Kenyan business to, and then what the private equity fund does is that it sells the shares in XX Company Limited. And anyone who gets the shares of the XX Company Limited definitely controls Kenya. And in that transaction, one, it happens offshore. So first of all, to even know that it happened is a problem. The other thing is that under the Kenyan tax legislation is that there is no taxation of such an indirect sale of shares. So, and what I mean is this: if XX Company Limited sold the shares in the Kenyan company, you see, first of all, the sale of shares and the change in ownership of XX Company Limited will have to be registered in Kenya, so that you say the shareholder in XX Kenya Limited has changed and this new person. The minute you do that, the transaction is flagged. And then because you're selling shares in a Kenyan company, you'll be subject to capital gains tax in Kenya at the very least. But in this case, there is an indirect sale, and Kenya does not tax indirect sales of shares. But what is even more is that private equity funds, like, their main business is investing and selling out. So because their business is not, because their core business is buying and selling of entities in this way, theirs will be a business profit. But you see, Kenya will not be able to tax the business profit that has been made in Europe. Although the value that is being derived from that sale is coming directly from Kenya. So think about it this way: the Kenyan company is doing so well, and the private equity fund has turned it around. It has made so much profit. The underlying asset here is the Kenyan company. So when it's sold in Europe, because this transaction is happening in Europe and not in Kenya, and the share is not changing in Kenya, despite the fact that the value is being derived from Kenya, the transaction, Kenya will be challenged if it decides that it wants to tax the business profits of the private equity fund. And you wonder why? Well, because there are international tax rules also, because you're looking at value, but under the Kenyan legislation one, you're taxable to income which is accrued in or derived from Kenya, even if you're non-resident. But the question would be, does accrued in or derived from Kenya mean that Kenya is the one that's giving value? Or does it mean that geographically this income is coming from Kenya? So the most common interpretation of accrued and derived from Kenya is that it's geographically coming from Kenya. It's territorial. It's within the Kenyan territory. You're getting income from the Kenyan territory. For instance, you have a mine in Kenya, and therefore your income is being accrued or derived from Kenya. But in this case, it's not territorial. The transaction, what we'll be looking at here is, first of all, because shares are an intangible, in the sense that you cannot compare it to a mine, and possibly the right word is not intangible, but there are choices in action. So now what happens is that there is value, economic value, like the very base of this transaction is in Kenya. But you see, it's hard to say that this income is being accrued in or derived from Kenya, because first, there's no money that's leaving the Kenyan borders. So think about it this way. If this transaction was such that money is being paid from Kenya, a Kenyan bank account, going to Europe, then you'll be saying there's money flowing out of Kenya, and you can see the money flowing. So like the example I gave of interest, the Kenyan company is paying interest. You will be able to see this interest payment leaving Kenya, and you can say it has been accrued in or derived from Kenya. But in terms of value, like there are people in Kenya working, there is sweat capital, there's what's happening in Kenya. You are not seeing any that movement from Kenya into Europe, and therefore it's hard to relate that there's that the income is being accrued or derived from Kenya. Of course, this is a very simplistic view, because there's things like transfer pricing rules. But even in such a case, transfer pricing rules become difficult to apply, because despite BEPS and OECD trying to align transfer pricing rules with the place of value creation, you realize that in the transfer pricing rules also, there's a very limitation of what the base eroding areas that are being looked at, because it's like a cash box. If someone is just giving capital or receiving risks, or has contractual risks, how do we reallocate profits to them? Again, we will have maybe another discussion about what the transfer pricing rules are. But as I've highlighted on the diagram, is that Kenya will be at pains to show how this income is being accrued in or derived from Kenya, especially because you can't see money actually leaving the Kenyan territory going to Europe. Money is coming from someone in Europe to the private equity fund in Europe. It's not even being seen in the tax haven. Money is changing from one bank account, let's say in France, to another bank account in France. The transaction is really off Kenyan soil. So those are the considerations that would come up, even if, as I said, this is very simplistic. But you would ask, what is the goal of this structure? It's tax planning, yeah, because you plan on how you can reduce your tax. And then I've tried to answer, would Kenya be able to tax the proceeds of sale of shares in XX Company Limited, the tax haven? And I'm saying it will be hard and difficult for Kenya to say that this income is being accrued in and derived from Kenya. One, because you can't see the income flowing from the Kenyan soil. But also the other thing is that how do you use value created by the Kenyan company as the basis of saying that the income is being derived or accrued in Kenya? Of course, there's been more progress in the discussions about like value creation and looking for ways of allocating profits to jurisdictions where value is being created, in this case which Kenya would have been able to benefit. But as it is right now, it's a struggle. And if you have been following discussions on like international tax, you know, especially for developing countries versus the developed countries, like in that scenario, the PE fund is coming from a developed countries, it's a struggle. And then the other thing you'd ask is that, is what I've just shown illegal? Well, tax planning is not illegal. Like, you'll not find any jurisdiction that says, you know, like if you're planning your tax affairs, that's illegal. It's not illegal because it's not tax evasion. What you're just doing is that you're looking for schemes to avoid tax. But in most countries, including Kenya and other countries, the UK, South Africa, most countries have general anti-avoidance rules. And what those are is that if the law provides that if you're undertaking any kind of business whose main purpose is such that you want to generally avoid paying tax, then that transaction will be disregarded. So there must be substance, one, in why there's a company in like the tax haven and why the transaction is happening in Europe and not in Kenya. So, and what if when the general anti-avoidance rules are invoked, what happens is that you ignore the entire structure and say that we will treat it as though the structure doesn't exist, but that this is a Kenyan transaction happening in Kenyan soil, and therefore we will tax it. Again, it's an uphill task because you need to show that the person is actually planning tax with the sole intention of avoiding payment of tax. You think it's easy, as I've explained it, but when it's a matter that you have to prove in court, so the burden of proof also now has to be quite high. But then the other thing that has been going on is asking, is it moral? Like doing this, what the private equity fund is doing, is immoral? It may not be illegal, but it's immoral. And if you have followed up discussions, it's the whole outcry of like how much tax like Apple pays, how much tax like Google pays, all these things, and people saying no, you're not taking your fair share of your tax of the tax burden. And then lastly, what I wanted to ask to discuss is what can be done. A lot can be done, yeah. So like for instance, African countries need to look for ways of just getting a fair allocation of profits that are generated from valuable intangibles or valuable creation of profits from their jurisdictions. So in short, African countries should be looking for ways to just enhance what is provided for in their legislation, so that it's not just accrued in or derived from Kenya, or it's not like gross income definition under the South Africa income tax. So you think that income is that sourced in South Africa will be taxed in South Africa. It's going further and defining what is sourced, that if you're creating value from assets within South Africa, then that amounts to source. And it's not just a question of profit allocation, but you want to have source taxing rights. Not just get the profit allocated to you, but have source taxing rights, even if those might be synonyms, because if you get a fair profit allocation to you based on the value that you've created using transfer pricing rules, then that's possibly as good as taxing at source. But this is assuming that you get a fair share. So I hope this discussion has been helpful to help you understand what we are normally always speaking about on Africa and the disadvantages that Africa faces. And I hope we can have another short tutorial in the near future. Thank you for listening, and you can leave your comments. Thank you and goodbye for now.